Today, let's go over everything you need to know about RRSP accounts. Hello and welcome back to my channel, where we talk about investing, personal finance, and dividends. If you're new here, consider subscribing to my channel and smashing that like button. Let's get started. RRSP is one of the registered investment account in Canada, and it stands for Registered Retirement Savings Plan. It was designed to help us save money for our retirement. The money that we contribute into this account could be used to reduce your annual income for the current year, so we pay less tax, which helps us save more money for our future. You do pay tax when you take the money out of this account, but generally we would be paying less tax compared to now because we would be in a lower tax bracket in our retirement. You can open an RRSP account with any financial institution like TD, Scotiabank, or BMO, or any investment brokerage platforms like SImplified or Questrade. There is a limit to how much you can contribute into this account, and it increases every year based on your annual income of the previous year. You can check the contribution room on the CRA website under My Account. The money that you contribute into your RRSP will reduce your contribution room. Any unused contribution room is carried over to the next year, so don't worry, it always accumulates. The new year's contribution room is determined by 18% of your earned income of the previous year, up to a maximum of $26,500. The maximum amount also increases a little bit every year. You can start contributing as soon as you have 1 year of work experience in Canada, and you can contribute up till the age of 71. You can contribute until March 2nd of the new year to your previous year's contribution room. And the available contribution room is calculated by any unused contribution room from previous years and the new contribution room that you just earned this year. When you're calculating how much to contribute, take into account the money that you put into the account, the money from an employer pension program, and the money from an employer matching program. All of these reduce your contribution room. So if you invest $3,000 and your employer matches $3,000, your contribution room decreases by $6,000 even though you only invested $3,000. If you have an employee matching program at work, you should definitely try to utilize this, as this is just free money. Make sure you do not over-contribute in your RRSP account. They allow a breathing room of $2,000 for honest mistakes, but generally you would have to pay 1% tax on the extra amount that you contributed until you take the money out. So try your best not to over-contribute in your RRSP account. Any money that you make in your RRSP account is not taxed as long as it stays in the RRSP account, and it does not affect your contribution room either. When you take the money out, you'll be paying tax for the amount that you took out. When you withdraw money from your RRSP account, there's usually a withholding tax that the financial institution holds on to and pays the government. For withdrawals up to $5,000, this is 10% withholding tax. Between $5,000 and $15,000, it's 20%, and above $15,000, it's 30%. You have to report the amount taken out of your RRSP account, and it will be added to your income of the current year. And depending on which tax bracket you fall under and how much tax you have to pay, if the amount is lower than the withholding tax, you receive a tax credit, and if it's higher, you have to pay the difference. There are 2 exceptions to this rule where you can withdraw the money out and not pay tax. It is the lifelong learning plan, where you're allowed to take $20,000 towards your studies, and the home buyer's plan, where you're allowed to take up to $35,000 for your first home purchase. If you take money out for these purposes, you do not have to pay tax on the amount that you took out, but you do have to contribute the amount that you took out back into your RRSP account within a given time frame, usually 10 to 15 years. It's basically like you're borrowing money from yourself. For you to be able to take money out through these plans, you must have the amount that you're taking out in your RRSP account for at least 90 days. An important note: if you take money out of your RRSP account not through one of these plans, you do not gain it back like the TFSA account. Once you take the money out, the contribution room is gone forever. So do not invest here if you're using it for a short-term investment. Use this account for a long-term tax-free growth on your investments. If you have to take money out of your RRSP account, check with your financial institution before you plan to take it out, because there might be deregistration fees attached to that as well. Transferring your RRSP account from one institution to another. If the financial institution completes this transfer for you, you do not have to pay any fees. If you manually take the money out of your financial institution and move it to another, you will have to do extra paperwork and report all that stuff, and you lose the contribution room forever. If you're considering moving your RRSP account from one financial institution to another, there's usually a closing fee or a deregistration fee or a transfer fee attributed to that. Some institution may reimburse you the fees depending on how much you transfer over. If you're sure you want to transfer, then make sure to ask your new institution if they'll cover your fees for moving the money. Normally, if you invest in foreign markets, you would have to pay foreign withholding tax. But if it's in your RRSP account, you do not have to pay foreign withholding tax because of something called tax treaties. It's a treaty with other countries around the world, so we don't have to pay tax twice, once under their taxation law and once again in our country. Since we pay tax anyways when we take the money out of our RRSP account, we do not have to pay foreign withholding tax for any of the countries listed in the tax treaties. Your investment can grow over time without incurring any additional taxes. This account helps you defer taxes right now and pay them 30 years down the line when you withdraw in your retirement. You can save a lot of money by contributing now and reducing your taxable income, especially if you're in the higher tax brackets, and delay the tax payments until retirement. Since you'll be in a lower tax bracket in retirement, you would pay way less tax than what you would pay right now. When you contribute into your RRSP account, you gain deduction limit, which is money that you can claim. It basically lowers your annual income of the current year, which leads you to pay less tax and save more money. Important thing to notice is that you do not have to use your deduction in the same year. You can contribute into your RRSP account and claim it in a year or a couple years. This is really useful as it allows you to get the most benefits because you choose when to claim the deductions. You can use this to your advantage by saving it for the future and claiming it to push you into a lower tax bracket. Let's look at an example. The amount of tax that you pay depends on how much money that you make and which tax bracket you fall under. If you make between $0 and $48,535, the federal income tax rate is 15%. If you make between $48,536 and $97,069, your federal income tax is 20.5%, so on and so forth. If you made $45,000 in 2020, you would be paying 15% tax on the total amount, which equates to $6,750. If you contributed $5,000 to your RRSP and you're claiming it, you would have saved $750. Let's say in 2021, your income increases to $55,000. On the first $48,535, you would pay 15% income tax, which equates to $7,280. And the remaining $6,465, you would be taxed at a rate of 20.5%, which is equal to $970. In total, you would be paying $8,250 in tax. Let's say you contributed $5,000 the previous year, but you never claimed it. If you claim the $5,000 right now, it would reduce your income of the current year. Your income would be $5,000 lower, and you would end up saving $1,025. So if you know you're gonna be in the higher tax bracket in the upcoming years, you should save your deductions and claim it then, which allows you to push yourself into a lower tax bracket so you end up saving more. By just waiting 1 year and knowing that you're gonna be in a higher tax bracket, you could save more, like in this example, where we saved 5% more. As always, make money work for you, not the other way around. You can check out WealthSimple and start investing today. I have another video that walks you through the setup. I'll leave a referral link in the description box below. If you use that link to sign up, fund your account $100 and buy some STONKS with that, you'll receive $10 and I'll receive $10 as well. Let's take personal finance into our own hands and make our money work for us. If you enjoyed this video, be sure to smash that like button and hit that subscribe button for more content like this.